Good morning. Marc Ostwald from ADM Investor Services International with some thoughts on Whatever It Takes 2.0. Today marks the 7th anniversary of that famous speech by Mario Draghi in which he said he would do whatever it takes to make sure that the euro stayed together, and indeed is widely attributed as what saved the eurozone from itself. Yesterday's ECB meeting, at which the statement basically strongly signalled that there would be a rate cut, probably as early as September, that they would be looking at more QE, that they would be looking at tiering deposits, was basically greeted by some as being whatever it takes 2.0, though one has to say that this is a markedly different situation. Yes, there are not positive signs in terms of the way the global economy is growing, but as Mr. Draghi himself said, this is largely a case of what's happening with the manufacturing sector, which he said where the outlook is getting worse and worse. And we are obviously in a very, very different stage to where we were all that time ago. So what have we got priced in just as a starting point? We have basically 10 basis points priced in for September. We have a reasonable chance of another 10 basis points thereafter, and only a small discount of anything after that. So what we're talking about here is a series of 2 10 basis point rate cuts. This is hardly whatever it takes 2.0. And I think it's important to keep that in mind. And if one actually has a look at the sort of things that Mr. Draghi was saying yesterday, and also this mantra that we have from many central banks, that it is as much about guidance or their rhetoric as it is about what they do in terms of taking action, then he seemed to be actually undermining some of the whatever it takes 2.0 impact. He talked about looking forward. Obviously, it'd probably be more a case for his successor, Madame Lagarde, to whatever new instruments that they may come up with, if there are any. That in itself is basically undermines the principle of forward guidance. He basically said he wasn't actually fearful that the Eurozone economy was going to go into a recession. He thought that the chances were quite small. Or pretty small, I think were the exact words. And he also basically talked about the some elements within the ECB's instrumentation for easing, perhaps being having diminishing returns. This is not the forceful sort of rhetoric that he was deploying 7 years ago. And here's a reason why. Let's go to the next chart, because this is really what the story is about. 7 years ago, on that chart, we were basically at a stage where there was no negative yielding debt in the world. Now, 7 years later, and we have almost 14 trillions worth of negative yielding debt in the world. It's little wonder that people chase all the riskier assets when there's so much negative yielding debt. But it also means with all that negative yielding debt in the world, it's actually really quite disappointing that the global economy finds itself in the situation where it is, where we're expecting the ECB to ease. There is talk that the Bank of Japan might even ease next week, and we are definitely expecting the Federal Reserve next week to cut rates by 25 basis points and dangle the carrot certainly of at least another 25 basis points thereafter. The market is in fact factoring in 3 rate cuts, but we've still got so much there. And so we sort of start to look around and we look at all this negative yielding debt, and the next table basically has all the 5-year debt in the world. There's a lot of negative yielding debt, and we have to ask ourselves, what can actually central banks effect when we've got so much negative debt in the world and the world economy isn't actually firing? So the world economy isn't doing that well, and we need to think about that somewhat more with a greater depth than expecting central banks to carry on the way that they have.